On or around August 20th, 2021, you can clearly see here that the S&P 500 was clearly peaking until it finally did peak in early spring or January or February of 2022 this year. Had you tried to build a portfolio, especially a dividend growth stock portfolio, you would have found yields too low to be attractive and therefore riskier, and you'd have also found valuations to be too high for the best of breed dividend stocks. So had you started a portfolio, a $1 million portfolio, and put it in the market back on August 20th, 2021, today your portfolio would be worth $893,000. You'd have got $17,077 in dividends, and you'd have actually lost, including dividends, 7.2% annualized. Now keep in mind, this is for 1 year and approximately 4 months. The point is that this was a horrible time to be building a portfolio. But go ahead and watch this video to find out how those portfolios would have done. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Back around August 27th of 2021, I did a series of videos on this channel where I talked about how to construct a dividend growth stock portfolio in one of the most challenging markets that we've ever faced. And you saw that clearly by the introduction to this video. I built these 3 portfolios using different strategies. I built one that was equal weighted with a focus on current income, trying to get a reasonable amount of income at the lowest risk possible. Then I also built one where I focused more on the growth of the income and was willing to accept lower yields to get more dividend growth going forward in the future, as well as capital appreciation potential. And then I did a third portfolio for maximizing income where I overweight 5 of the 20 stocks that I built in the portfolio that were high yield, with 15 lower weighted stocks. So those 3 videos, I've put links on them to this channel. The first one was done on August 20th, 2021, titled How to Build a Dividend Income Retirement Portfolio in Today's Market, emphasizing today's market being very, very challenging. We put links to those videos below so you can see them. The second video I did on August 24th, 2021 was called Constructing a Personal Dividend Income Portfolio in Today's Challenging Market, Part 2. This is where I actually built the portfolio on this day, August 24th, and then I did a final Part 3 video where I talked about 3 model dividend growth portfolios for 3 different objectives, as I mentioned to you earlier here. Now, I want to make a couple of points. I put these portfolios together in what I consider to be one of the most challenging stock markets we've ever faced. So let's go ahead and look at those 3 portfolios in the following PowerPoint slides. My equal weight income model, I call model number 1. Again, all these were produced on August 24th. I put 20 stocks in the portfolio, as you can see here by these names here, and I put $50,000 in each one to construct a $1 million portfolio. The current yield on purchase of these 20 stocks was 4.15%. That was significantly above what the S&P 500 was offering in terms of current yield. As I often say, it's a market of stocks and not a stock market. And even though it was very hard to find good quality companies at attractive yields, as you can see, I was able to put together a portfolio here with an average yield on purchase of 4.15%. The original income this portfolio starting out would generate on a $1 million investment was $41,415, or 4.15%. The value as of December 12, 2022 was $1,071,944.22. So we had about $71,000, almost $72,000 of capital appreciation, but the dividend income on this portfolio had grown from $41,515 to $56,576 to give a total of this portfolio $1,128,520. Now contrast that to the loss that you'd have earned if you invested in the market. This portfolio is actually holding its own pretty well. However, I do want to emphasize this is only about a 15 or 16 month holding period, which is way too short to judge a portfolio. But as you can see here, we had several stocks that have done less than what they originally invested and several that have done better. That's the power of diversification. I'm going to be covering this model 1 portfolio in detail in this video. I'm going to do this as a 3-part series. In part 2, I'm going to look at our equal weight growth model where we had some of the similar names but slightly slightly different names across the board where we were focused more on growth. This $1 million portfolio started out with a current yield of 2.35% or $23,475. It ended current value now as $1,166,000, so it did a little better than the first portfolio capital appreciation wise. Dividend income was only $33,867. That's in contrast to the $56,000 and the $1,071,000 in gain. Here we got $166,000 in gain. So the value, ending value, including dividend income, was $1.2 million. The growth yield on these stocks have increased dramatically. For example, in Amerisource Bergen, you could see we started out with a 1.47% yield on purchase, but we ended up with 2% going forward. We're going to cover this in more detail in part 2. And then part 3 was an overweight portfolio where we put 5 companies with $100,000 or $500,000, half of our $1 million portfolio in 5 companies. And then the other 15 companies, we put 33.33% or $33,333. So this gave us some concentration in the highest yielding. You can notice here that EPD was 8.43%. Philip Morris, or Altria as it's actually called, was 7%. Then we had 8% on Omega Healthcare. And then we had 4.4% and 4.47%. So this would be the overweight Model 3. But what we're going to do is go through our first portfolio here in this video, and then in the following second part and third part of this series, we're going to go ahead and include the rest of the video. So let's go ahead and look at this Model 1 income portfolio where we're going for maximum income through the lens of the fast graph portfolio system. Let's start out with current dividend yields. All right, these are the current dividend yields if you bought this portfolio today. Okay, this is not what we started out with. These are the various credit ranges. You see, we've got mostly investment grade stocks, but we have a few that are not investment grade, like Chemours Company was below investment grade, and UGI, which is a very high quality gas utility company, did not apply for a credit rating. We have various levels of debt to capital, and we have valuations and earnings yields. Looking at earnings yields here, currently, most of them still meet our 6.5% criteria, but we do have a couple that have simply become overvalued based on earnings. One in particular, but based on cash flow, VICI Properties is still looking pretty good as a REIT. So these were the stocks that we were looking at. I'm going to go through these one at a time for you to give you some granularity into how these portfolios have performed, remembering that the S&P 500 was trading at a very high valuation when I built these portfolios. Back here between August 20th and August 27th, we were looking at 25 to 30 multiples, and we were looking at a yield that was actually quite low. I can look at my dividend yield on the portfolio and see that during this period of time, I had a starting dividend yield of somewhere between 1.5, 1.3 to 1.5%, maybe 1.5 to 1.7, looking at that. So valuations were high, yields were low. But going into this portfolio, we were able to purchase AbbVie at a very attractive price and value of $119.68 at a PE ratio of only 10. As you can see, that $50,000 we originally invested today is worth $69,067.39. Add in dividends of just under $3,000, and we have a total of $72,000 or a 32.5% rate of return. This has been an extraordinary position for us so far. But once again, I want to remind you that the time frame here is too short to be able to judge how well this is doing. It's only been 1 year and 4 months. The next stock we purchased was Amgen. We again were able to purchase Amgen even though the market was inflated at a very attractive price of $224.38. Today the stock is trading at $276.78. That $50,000 has grown to $61,667. Add in $2,000 plus dividends, we got a value of over $63,000, a 20.7% rate of return. In this short period of time, this has been an excellent investment for us. Moving on to Franklin, which does pay special dividends from time to time, I want to point out, we bought this stock at a very attractive valuation. The PE was only 8.6. Currently, the PE is down to 7.97. The stock rose and then it's fallen. Part of it due to some, earnings issues. That $50,000 is only worth $43,000. and we've lost about 6.7% if we were to liquidate it today. But we think this stock, again, is worth something between $35 and $40 a share. And currently it's only trading at 27. So that's one of our losers in the portfolio. Cardinal Health has been one of our best winners. We originally bought it at $51.77. That $50,000 is now worth $76,800. That's 53% growth. And again, a very short 1 year and 4 month period of time. Add in $2,400 of dividends, and you've got a 42.5% annualized rate of return. This has been a super holding, and you can see that valuation matters, and it matters a lot. This stock was extremely inexpensive and now has rallied very strongly in a very short period of time. And the stock is only it's at fair value today. I wouldn't call this the bargain it was the last several years, but it's certainly not overpriced yet. It'd be one that we would be very comfortable continuing to hold. Chemours is one that we invested $50,000 in at $33.57. Today, the stock is trading at $30.52. So we do have a modest loss on the stock in 1 year and 4 months. Annualized loss of about 4.1%. But I think the important factor is here, I see the stock worth $46 a share right now as we sit, and it's only trading at $30 a share. So my point is, measuring performance without simultaneously measuring valuation is a job half done. Valuation tells me this stock trades at a very low normal PE of 9, but earnings support a much higher price than the company is currently trading at. So I'm very comfortable with this position because, again, it's only been a short holding period. Eastman Chemical was one that we were kind of forced to purchase at fair value because finding attractive value was almost impossible. We did do it on a few occasions, as I've already shown you, and I'll show you some more here in a moment. But we bought this at fair value. It rose real nicely right after we bought it, but then it's fallen since then. So now, we're looking at a stock that I think is worth over $125 a share. You can buy it at $86.48. However, since we've owned the stock, we have a loss of about 15.8%. The $50,000 investment is only worth $38,255, but we have received $1,700 in income. And note that the dividend income has increased since we've owned the stock. So I believe this stock is worth $123 a share. Buy all you want at 86. The next stock is Enterprise Products Partners. This is a very high yielder. We originally bought this stock and put $50,000 on August 24th. That $50,000 is worth now $54,000. But look at the whopping dividend. This stock has paid $5,115 in dividends. When we initially bought the stock, we were getting an 8.43% yield. That yield has increased to over 11% now through growth yield as the company has raised the dividend since we've owned it. And again, we've only owned this a very short period of time. Too soon to judge. HPQ is one that we originally bought at a very attractive price of $28.90. The stock went up to over $36. Then it fell down to, almost $25. Now it's trading at $29. And we've got a slight loss in this one. However, the market value, I stand corrected. We've got a slight break even on this stock. We're up about $200. It has paid a nice dividend. Add the dividend in, and we've got a $50,000 original investment. It's worth $52,300. We're averaging about 3% annualized rate of return in the short term we owned it. Once again, valuation matters, and it matters a lot. But we did have a short period of time where we actually had an extremely, attractive profit in this stock, where we were, it was over $67,000 in value. That's how volatile stock prices can be. And what I always say, stock prices are pathological liars. You really can't trust them. Next stock on our list that we're going to look at is Ingredion. Ingredion is a flavors manufacturer, spice manufacturer, agricultural products. We bought this stock at a very attractive valuation and price of $87.12. When we originally purchased it, it did rally to $97, then dropped again, then rallied again. This is what I mean when I say you can't trust stock prices. They're so erratic. Today, though, however, the stock is trading at an attractive price of $98.99. That's given us a very nice capital appreciation of about $6,000 on the stock. Add in almost $2,000 in dividends. We're at $58,000. That's a 13.3% rate of return. Once again, buying the stock at a good value, even though the holding period is too short here has rewarded us very nicely on Ingredion. JPMorgan, which I consider a very high quality diversified bank, we bought this stock when it appeared to be undervalued, and it did rise a little bit after we bought it. Earnings came in really good for the year, but then they're expected to have, a really bad year this year. The stock has fallen dramatically. We invested $50,000. It's currently worth $42,000, but we have received $1,600 in dividends. And I think the important thing is, I believe the stock that is currently trading at around $134 a share is worth $175, and then going on to being worth over $200 in the next couple of years. Valuation matters. I don't see this stock as a loser. I see it as a great long-term winner. The next one was Altria MO, symbol MO. We put $50,000 in this stock, and we bought it at a price of $48.21. It's currently trading at $46.96. So what we have here is just a very slight loss relative to capital, but you add in the dividend income of $4,905, and we've actually got a total value of $53,607, a 5.5% annualized rate of return. What this speaks to is the importance of dividend income. Even though the stock is down ever so slightly in price, we've got a positive rate of return thanks to the very high dividend yield. And again, I think this stock is worth something north of $68 to $70 a share, and you can buy all you want today at $46 a share. The risk of owning this stock is already priced in my opinion. Merck is one that we bought undervalued. As you can see here, it was, again, finding value was very hard. We bought the stock at $77.72. The stock currently trades at $108.97. We've made it's worth, that $50,000 is worth $70,000. We're averaging almost 33% a year. And once again, we got $2,275 in dividend income since we've held the stock. And remember, on these portfolios, on this equal weight income portfolio, the focus is on the income. How much income are we generating? Capital appreciation will take care of itself in the long run. Omega Health Ventures is a REIT, so we'll look at it looking at funds from operations. We bought this stock at a price of $33.26. It currently trades at $29.57, so we're showing a slight loss, but you add in the $5,239 lavish dividend received, and we're virtually breaking even. We're down less than, maybe around 0.5% in this stock. And again, I think this stock is easily worth $44 a share. You can buy all you want at $29.57. Any risk of owning this REIT, I believe, is already priced into the low valuation. OMC, Omnicom. We bought this stock at an attractive valuation, price of $72.59. Currently, the stock is trading at $78.29. We've got a slight profit, but we received a nice $2,541 in dividends. We're averaging almost 10% a year, and again, we've only owned this for a very short period of time. Looking at it from an earnings point of view, we bought it with a good margin of safety. It rose, fell, and rose again. I think in the long run, this stock is worth, almost $100 a share or more, something in that neighborhood. You can buy all you want for $78.29. Looking at the next stock, we're looking at Principal Financial Group. PFG is the symbol. We bought this at a very attractive valuation of $66.87. The stock closed yesterday at $90.27. Our $50,000 has turned into $67,000. That's averaging just under 30% a year annualized. But again, too short a period of time frame, but we're pleased that this one is performing well for us. Now, this is a very interesting one. South Jersey Industries was a utility that offered a very attractive yield at the time we bought it. We were able to get almost 5%, 4.9% on the purchase price and the yield on the purchase price. The company's now gone into a merger agreement. We're going to be doing some work. I believe it's become overvalued. But the bottom line is that original $50,000 we invested is now worth $71,620. That's a 36.4% annualized rate of return. But again, the period's too short, but now we're looking at an overvalued stock in the portfolio, and we're going to be looking for a replacement for this because, as you can see, it's been marking time since the merger announcement. It's trading about $1 or $2. I forget the exact one. Now, I think it's $36 valuation on the merger, so it's almost trading at what I would call full value right now. UGI Corp, which is a gas utility, we bought it at full value, fairly valued, but full value at $46.31. The stock is now trading at $38.98. We have a loss of annualizing about 9%, but we did get almost $2,000 in dividends. The dividend is growing. I think this stock, again, is worth somewhere in the $45 range. You can buy all you want at under $40 a share. Valuation matters, and it matters a lot. VICI Properties, a experiential REIT, is very interesting. I'm going to shorten the time frames. You get a better sense of the valuation and the growth. It is a REIT, so if you look at it from a standpoint of operating cash flow, we paid a slight premium for it based on its funds from operations, but we bought it at a reasonably attractive valuation with our original purchase price. The yield was 4.4%. That income has grown. We've gotten $3,237 in dividends. We're averaging 16.6%. I consider this company fully valued, but not cheap, and not massively overvalued, but I probably wouldn't be a purchaser today, although I did purchase it at a similar valuation because, again, value was so hard to find. But yet, by being disciplined about valuation, as you'll see here when I summarize, we did okay. The next stock we want to look at is Verizon Communications. Now, Verizon has been a very poor performer for us recently, but it is starting to recover. The fundamentals have held up a lot better. I don't believe it deserves this big sell-off here, but the $50,000 we put into Verizon, if we were to sell it today, is only worth $34,000. But we did receive $3,000 in dividends. And I think Verizon, from a standpoint of valuation, I think Verizon is easily worth $75 to $80 a share. You can buy all you want today at $37. Of course, it's offering almost a 7% yield, 6.88% if you buy it today. We bought it at a yield of 4.57%, and that yield has increased over 6% on cost, or growth yield, I'd like to call it, for us in the short time we've owned it, but it hasn't performed well yet. But again, valuation matters, and it matters a lot. I think fundamentals, even though there's no growth here, I think the fundamentals are going to be strong for this company. And last but not least was Walgreens Boots Alliance. I really felt like we bought this at an extremely attractive valuation. It actually increased a little bit in value before falling precipitously on a lot of different kinds of news. It's now starting to rally. That $50,000 is worth $42,000, but that's a minus 7.7% rate of return. Looking at a recap of this portfolio, it was our equal weight model where we put $50,000 in each company, started out with a 4.15% yield. Today, that has grown to 5.66% on what I like to call growth yield, or other people would call it yield on cost. The $1 million portfolio is now worth $1,071,000, almost $72,000. It's currently generating $56,000 in dividend income. That would give us a valuation of $1,128,000. And again, it's early in the story. The portfolio is only a year and 4 months old, but this really says a lot about value investing. We invested this in one of the worst stock markets for a value investor that I can remember, and doing this for almost 5 decades, and yet we were able to eke out a positive rate of return after a year and 4 months, and we're generating substantial income, and that income has increased at a very substantial rate. So I really like what I see here, and I think we've got a lot of opportunity, and we'll revisit this portfolio again in a year. In part 2, I'll be covering the second portfolio, and in part 3, I'll be covering the final model, which is the overweight model. The second portfolio will be more oriented for growth. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the fundamental analyzer software tool, bringing you the update of the model portfolios we built back in August of 2021. As you can see, the portfolio has held its own very nicely in a market that's actually gone down somewhat. But again, it's only been a year and a half. You can't judge a portfolio in that short a time frame, number one. And number two, measuring performance without simultaneously measuring valuation, which I tried to interject throughout the review of this portfolio, is a job half done. You've got to basically look at both. Now, I pay more attention to what I believe my portfolio is worth, because I don't believe in ever selling anything for less than it's worth. Anyway, I hope you enjoyed this video. If you did, give me a like, ring the bell, subscribe to the channel if you haven't, and take a look at subscribing to FastGraphs. You can see all the really neat features this tool offers you and can really help you, be a much better investor long term. Even in the worst market in history, you can end up building a portfolio that gives you substantial income and positive rates of return. I hope you enjoyed it, and we'll talk to you again in part 2.